Today is Tuesday, March 24th, 2026. If you only looked at where silver closed today, you missed the most important thing that happened this week. Silver opened at 69.96. By mid-session, it was pushed down to a low of 66.16, a nearly $4 intraday decline on a day when every macro headline was written to justify exactly that kind of selling. Then sellers ran out of metal to sell. Silver reversed aggressively, closing at $73.15, up 5.46% on the day. Gold closed at $458,060, up 3.18%. I am the Asian guy, and I want to be very precise about what that reversal represents. Today's open, low, and close are not just three numbers on a price chart. They tell you who has control of this market and where that control is migrating. The paper mechanism opened today and it tried to push silver lower. It got to $66.16, and then something happened that the paper sellers did not plan for. Buyers appeared. Not one buyer, not one market. Buyers in Singapore, buyers in Istanbul, buyers in Beijing. Physical buyers across multiple continents who looked at $66 silver and made the same decision. That number is an opportunity, not a warning. The session closed $7 above its intraday low. That $7 recovery is what today is actually about, and I am going to show you exactly who generated it, where they are operating, what data they are reading that the paper sellers are not, and what an intraday reversal of this magnitude tells us about the state of the physical silver market right now. Stay with me because the price you watched move today is telling a very different story depending on which part of the session you focused on. Let me start with the environment the paper market was operating in this morning. The selling pressure that drove silver to $6,616 was real. The triggers were identifiable, and understanding them is necessary before you can understand why they failed to hold the price down by the close. The CME FedWatch tool now shows an 8.3% probability that the Federal Reserve raises rates at its very next meeting. Extend that timeline to October, and the data shows a combined 27% probability that rates move higher from their current level of 3.5% to 3.75%. 6 weeks ago, the word rate hike was not a live conversation. Today it is. And in the paper market, that shift in language is enough to generate selling pressure. Layer on top of that the geopolitical picture. The Iran situation and the surrounding regional environment remain active variables. Overnight, a social media post from President Trump indicated that a planned bombing campaign was not proceeding. Financial markets reacted within minutes. The S&P 500 surged. Oil retreated as geopolitical risk premium unwound rapidly. And the safe haven demand that had been partially supporting silver through that risk environment dissolved in a single narrow window. Now here is a specific detail from this morning's sequence that deserves your focused attention. At 6 hours and 50 minutes in the morning Eastern Time, $1.5 billion notional value of S&P 500 futures contracts were purchased in a single order. That order alone was large enough to move the entire index upward by 0.3% in 60 seconds. 14 minutes later, at 7 hours and 4 minutes, President Trump posted on social media that productive discussions with Iran were underway. By 7 hours and 10 minutes, the S&P had added $2 trillion in market capitalization. It is urgency. Move to Beijing. Major banks in China are reporting that gold bars weighing less than 50 grams, less than 2 ounces of metal, are out of stock at retail banking locations. Purchasing physical gold in Beijing now requires a scheduled appointment at the branch. And that appointment does not guarantee availability when you arrive. A customer can travel to the branch on their booked day and leave empty-handed. Demand has outpaced inventory replenishment at the institutional level. Now look at the Shanghai data from today, Tuesday, March 24th. The spot silver price in China sits near $77 per ounce, nearly $4 above where COMEX was pushing silver this morning. But the spot level is not the most significant signal from Shanghai today. The Shanghai futures market is in backwardation. In a normally functioning commodity market, futures prices trade above spot. The buyer who accepts future delivery instead of immediate delivery pays a premium because capital committed to deferred settlement has a cost over time. When that relationship inverts, when the market price is spot above futures, it means buyers are willing to pay a premium for metal they can hold right now, rather than accept a discount for metal promised later. Backwardation is the market's explicit statement that immediate physical possession carries a scarcity premium, that a promise of future delivery cannot replicate. This condition does not arise from paper trading. It arises from physical supply being insufficient relative to physical demand at the present moment. The Shanghai silver market today is saying in the language of price structure, What you can hold now is worth more than what you are promised for later. There is one voice in the silver market that carries a form of credibility no analyst or chart technician can match, because his visibility into silver supply is not theoretical, it is operational. Keith Neumeyer is the founder and CEO of First Majestic Silver. He runs a business extracting physical silver from the ground every day, managing ore grades, production costs, and getting mine metal into the market. His reference for silver's value is not a futures curve. It's not a momentum signal. It is the physical supply chain itself observed from the inside. This week, Neumeyer made a specific public statement. He said triple-digit silver will return. He added, give it a few months. He said, new highs are coming for silver prices. He confirmed the rally from $30 to $121 was physically driven, not by speculative paper leverage nor momentum-chasing retail flows. The engine was physical demand. Here is why that distinction matters structurally. And when a speculative rally collapses, the demand is gone. Buyers were leveraged paper positions. When they unwind, the price collapses with no fundamental demand floor. The correction reveals the emptiness that was underneath the move all along. When a physically driven rally corrects, the buyers who generated the move still exist. They still want the metal. They still have a thesis built on something other than price going up. What changed is the price they can access that metal at. A buyer with conviction at $100 now has access at 28% below. The correction does not eliminate conviction. It deepens it and improves the acquisition price. Keith Neumeyer, running the world's most prominent silver mining company, called for triple-digit silver within months. That is not a price target generated from a chart pattern. It is an operational read from direct visibility. The gold-to-silver ratio today confirms the arithmetic from a completely independent angle. With silver at $73.15 and gold at $5,860, the ratio sits above 62 to 1. The historical mean across multiple precious metals bull cycles is 40 to 50 to 1. Apply the lower bound of that historical range to today's gold price. Silver should be priced above $91. Apply the midpoint. Silver should be priced above $100. At no point does anything need to go wrong. The ratio simply needs to return to where it has historically traded during comparable gold bull markets. The 100-year chart of the gold-to-silver ratio has broken above a long-term structural trend line. It is now retesting that breakout from above. In every prior instance, silver outperformed, not gold declining to meet silver's current price. The slingshot, as described by technicians, is more compressed today. More compressed means more potential energy stored in the ratio divergence. There is a number from the end of last week that received almost no coverage in today's analysis. It may be the single most structurally significant figure in the entire current silver market picture. Total COMEX silver open interest as of Friday was 111,000 contracts. That is the lowest level of paper silver participation recorded on the COMEX in 14 years. The paper mechanism that has historically set the benchmark price for silver globally is operating at a level not seen since before the last major silver bull cycle. Fewer paper contracts are outstanding today than at any point across the entirety of the current advance from $30 to $121. The paper market is contracting. What does it mean when a price-setting mechanism shrinks while the physical market it is supposed to be pricing is simultaneously accelerating? A paper market at a 14-year participation low has fewer available sellers to generate selling volume. It has less capacity to maintain a price below what the physical market would independently set. Each dollar of physical buying pressure has proportionally more impact on the price when the paper book is thin. The resilience of paper selling depends on how many paper sellers are available to replace those who exit. At a 14-year open interest low, that replacement pool is at minimum depth. Today's intraday reversal from $66.16 to a close of $73.15 is visible evidence of this dynamic. The paper sellers pushed silver down nearly $4 from the open. The physical market absorbed the selling, reversed the entire move, and added additional gain on top. By the close, silver was higher than it opened. The paper mechanism tried, the physical market answered, and the paper mechanism at a 14-year participation low did not have enough depth to prevent the answer. There is a category of silver and gold demand now operating at a scale it has not reached in any prior cycle at the subnational level inside the United States. And it represents a form of conviction that does not reverse on an intraday price flush. Wyoming has constructed a dedicated physical storage facility, the Wyoming Reserve Vault in Casper, and has begun formally purchasing gold as a component of its official state investment strategy. Wyoming joins Texas, Missouri, New Hampshire, and a growing cohort of American states that have moved beyond legislative symbolism into the act of physically acquiring and vaulting precious metals. These are not portfolio trades. These are explicit governmental decisions made by elected representatives with fiduciary obligations to state treasuries. That dollar-denominated reserve assets alone do not provide sufficient protection against monetary system instability. Expand the frame to the global sovereign level. Ray Dio, whose track record in global macro investing gives his observations institutional weight, stated publicly this week that the world's central banks are buying gold in massive quantities. This is visible in reserve disclosure data from central banks across multiple continents. It represents multi-year policy-level capital allocation, decisions made by institutions with century-long investment horizons that do not reverse because Tuesday's paper market had a difficult morning. And then there is a development at the intersection of digital finance and hard asset reserves that deserves specific attention. Tether, one of the largest stablecoin issuers in the world, responsible for maintaining a substantial reserve balance sheet, is now the largest institutional buyer of gold after the world's central banks. A company whose entire commercial infrastructure is built on digital money has chosen physical gold as a core reserve asset. That decision was not made to generate quarterly return. It was made because the people managing Tether's balance sheet determined that in an environment of escalating monetary system uncertainty and deteriorating confidence in legacy financial institutions, physical possession of hard assets provides something no paper instrument can replicate: unencumbered ownership that does not depend on a counterparty's ability or willingness to perform. Silver exists inside the same structural allocation trend with an additional characteristic: a ratio to gold that implies historical undervaluation. At every price level gold is traded at across this entire cycle. Silver's industrial demand is not a macro narrative. It is a physical schedule. And the geopolitical environment that generated this morning's paper selling pressure is making that schedule more important, not less, in a way that today's coverage has completely missed. Solar panel manufacturers are the single largest category of industrial silver consumption. They operate under long-term power purchase agreements with downstream customers. Their factory production schedules are determined by those contracts, not by the day's commodity prices. When input costs rise from energy, transportation, manufacturing materials, the manufacturer cannot reduce silver content. The silver in a photovoltaic cell is specified at the engineering level. The quantity is determined by the physics of how a silver contact interface converts photon energy. That quantity cannot be substituted without redesigning the cell, which is a process measured in years, not quarters. The oil shock from the current Iran situation, the same event that pushed the paper market to sell silver this morning, is simultaneously increasing production costs for manufacturers who need silver and will continue consuming it regardless of what the COMEX shows. The geopolitical event that the paper market used to push silver to $6,616 today is the same geopolitical event that is reinforcing the industrial consumption floor for the metal defense electronics, medical devices, electric vehicle power management systems. Each of these manufacturing categories runs on specifications and procurement contracts that do not reprice in response to an intraday futures flush. The factory line that needed silver yesterday needs silver today. It will need silver tomorrow. If that consumption does not pause because CME paper participants decided the macro narrative was negative. The paper market priced one effect of the geopolitical situation this morning: rate expectations higher, dollar firm metals lower. What it did not price, what it structurally cannot price in a single session, is the sustained physical consumption from manufacturing processes that run on a schedule the paper market has no access to and no mechanism to interrupt. There is a framing exercise that changes how today looks entirely, and it comes directly from the price data. 3 months ago, silver was trading at approximately $7,169. Today, silver closes at $73.15. The net change across 3 months, a period that included a run to $121.79, a single-day crash of 31.37% on January 30th, a recovery through the 80s and into the low 90s in February, multiple subsequent correction phases, and today's violent intraday flush, followed by a $7 reversal, is a gain of approximately 2%. Now consider what that means. If you had been told on December 23rd of last year that 3 months from now silver would be at $73, you would have called it an excellent outcome. You would have said silver built a platform above $70, digested a historic amount of volatility, shook out every participant who could be shaken out, and emerged 2% higher on a net basis from a level that was already more than double where it was trading a year prior. You would have described that as a healthy consolidation above a major technical breakout. What actually happened inside those 3 months is that silver went to $121.79. It crashed back to $74 in a single day, recovered toward $93, corrected again, and today tested $66.16 before closing at 73. Every one of those shakeouts removed holders whose conviction was dependent on the price continuing to rise. Each correction identified a level where physical buyers stepped in with enough volume to reverse the move. Buyers who remain still holding silver at $73 tonight are not momentum traders. They are holders who understand why they own the metal independent of what the daily chart does. Today's intraday low at $66.16 is now a tested and publicly confirmed level. Buyers appeared there. They generate enough buying volume to close the session $7 higher. That level now carries structural information it did not carry yesterday morning. Let me give you the historical pattern from this specific cycle because today fits it precisely. Recognizing this template matters for how you interpret what comes next. On January 29th, silver touched $121.79 intraday. The following day, January 30th, it crashed 31.37% in a single session. The low on January 30th was $74. The narrative was identical to today. Silver is overextended, professional money is exiting, the speculative run is ended, fair value is lower. Then February began. Silver built between $76 and $84 through the first 2 weeks. By February 27th, it had recovered to $93.29, nearly $20 above the January 30th crash low. Then March began a second correction phase. Silver pulled back toward $79 in mid-March. A second recovery followed, pushing back toward $90 by March 10th. A third correction phase followed. Today's session brought the intraday low of $66.16, the deepest test of any level since the January 30th crash, and the session closed up 5.46%. The pattern is consistent across every phase of the cycle. Paper selling generates a flush. The flush tests a lower level. Physical buyers appear at that lower level in volume sufficient to reverse the move. The recovery that follows resets the base higher than the prior correction low. Each successive test of a lower level is absorbed faster and reversed more sharply than the one before it. The buyers who entered at $74 on January 30th are in a profitable position. The buyers who entered at any of the subsequent intraday lows across February and March are in a similar position. The buyers who entered at $66.16 this morning generated today's 5.46% close. The pattern does not guarantee what happens next, but it documents what has happened every time the same structure has appeared. Let me address the bear case directly because it will circulate more aggressively tonight than usual, and you need specific data to evaluate each part of it on its own terms. The first argument is that the January peak at $121 was speculative excess, and the true fair value is in the 60s or lower. Keith Neumeyer confirmed this week that the move was physically driven. Speculative markets do not generate 3 times normal physical buying volume at Bullion Star in Singapore on a price dip. They generate selling on a price dip. The physical demand response at Bullion Star today is structurally incompatible with a speculative excess narrative. Physical buyers do not materialize in volume at a down day low in a market that is correcting from a speculative bubble. The second argument is that the gold to silver ratio is acceptable at current levels and does not imply undervaluation. The 100 red-year chart of this ratio has broken above a long-term structural trend line in every prior instance across the documented history of this ratio, where the pattern matched what is happening today. The resolution was silver outperforming to compress the ratio, not gold declining towards silver's price. At today's gold level of $5,860, a ratio reversion to its historical lower bound implies silver above $91 to the midpoint of the historical range above $100. Silver at $73.15 against gold at $4,580 is not overvalued. By every historical ratio standard, it is measurably undervalued. The third argument is that professional money is selling silver. This statement requires a precise definition to be analytically useful. The COMEX paper market has seen its open interest fall to a 14-year low. That means paper participants have been exiting. At the same time, Bullion Star reports 3 times normal physical volume. On a down day, buyers in Istanbul are standing in physical queues, and Beijing banking clients cannot access gold bars under 50 grams without an appointment that may not deliver. The actors reducing paper exposure and the actors absorbing physical supply are not the same. Professional money is selling describes one side of a two-sided market. The other side is buying physical metal in volume. Both are true simultaneously. The fourth argument is that today's price action below $70 confirms bearish continuation. Silver did not close below $70. It closed at $73.15 after testing $66.16 intraday. The bears had their opportunity at that intraday low. The physical market did not allow the close to confirm it. There's a structural feature of how large financial institutions participate in the silver market that creates confusion on days like today, and resolving it is necessary for reading the signals correctly. A major bank may simultaneously have a futures trading operation that is reducing paper silver exposure, contributing to the open interest decline, generating downward price pressure in the session, and a physical commodity team that is using the lower paper price to accumulate physical metal at an improved acquisition cost. These are not contradictory positions. They are two business units operating on entirely different time horizons through the same institution, running strategies that are not in conflict with each other. The futures desk seeks short-term returns from volatility and macro positioning. When the narrative is negative, it sells paper. The physical team seeks long-term possession of real assets at the best available price. When the paper desk selling creates a lower price, the physical team's acquisition cost improves. The futures desk's activity is what registers in the price data and the open interest figures. It is the visible portion of the institution's activity. The physical team's accumulation shows up differently in vault flows and the physical premiums that persist at dealers, even when paper prices fall in the pattern of physical demand data from locations like Singapore, Istanbul, and Beijing that is visible today. The institution that appears in the paper market to be selling silver this morning may be the same institution whose physical operations team was a buyer when the price reached $66.16. The paper market sees the first, the physical market records the second. Understanding that both are occurring simultaneously through the same entity for different reasons on different timescales is the difference between reading today's price action accurately and being confused by the apparent contradiction of a market that sells on the screen and buys in the vault. Here is where everything from today's session comes together. Silver opened at $69.96, was pushed to $6,616 by paper, selling rooted in rate expectations and a geopolitical sequence that is itself under public dispute by a sovereign government, and was then bought by physical buyers in Singapore at 3 times normal daily volume, by buyers in Istanbul standing in physical lines outside the Grand Bazaar, by buyers in Beijing booking appointments at banks whose inventory of small gold bars had already run out, all the way back to a close of $73. $3.15, up 5.46% on the day. The paper mechanism, operating at its thinnest participation level in 14 years, generated a nearly $4 intraday decline. The physical market absorbed it, reversed it, and closed the session higher than it opened in a single session. Gold at $4,580.60 against silver at $73.15 produces a ratio above 62 to 1. The historical mean is 40 to 50 to 1. The mechanism for that ratio to normalize is silver outperforming. The physical demand documented today in Singapore, Istanbul, Beijing, and Shanghai is the active form of that mechanism. The sovereign accumulation from Wyoming's reserve vault to the world's central banks to Tether's reserve balance sheet is the structural form of it. The industrial floor from manufacturing processes that run on procurement contracts, independent of the paper price, is the persistent daily form of it. Keith Neumeyer's public call for triple-digit silver within months is the supply side rid on the same dynamic from the CEO of the world's most prominent dedicated silver mining company. 3 months ago, silver was at $7,169. Today, it is at $73.15. The net 3-month movement across everything that happened in between 121 peaks, 31% single-day crashes, multiple sharp corrections, and today's $7 intraday reversal is a gain of approximately 2% from a level that had already more than doubled from a year prior. The base has not broken. It was tested today at $66.16. The physical market said no. The COMEX paper mechanism at a 14-year participation low is a mechanism whose capacity to maintain a price below physical reality is diminishing by design. Fewer paper participants means less selling volume available to offset physical demand. Less selling volume means each wave of physical buying has proportionally greater price impact. The intraday reversal you watch today is the arithmetic of that dynamic playing out in visible, documented, time-stamped price action. The buyers who stepped in at $66.16 this morning are not waiting for confirmation. They already decided. The sellers who drove the price to that level are the ones who need confirmation. And by close today, the only confirmation they received was that the physical market was bigger than they were. If today's breakdown helped you understand what a $7 intraday reversal in silver actually documents about the balance of power between the paper mechanism and the physical market underneath it, subscribe to this channel, hit the notification bell, share this video with one person who watched today's intraday low and drew the wrong conclusion about what it means. The paper price tells you what the sellers tried to do today. The close tells you what the physical market did about it. This is the Asian guy. I will see you in the next.